morning. You're watching The Market right here in 18 now with me, Ayesha, Faridi, Avanne, Dubash, Nikunj, Dalmia in the studios. And it is the job reports, actually, which is souring the sentiment across the global street this morning. In fact, if you just take a look at how the private sector data, jobs, ADP showed, there was an addition of about 4,97,000 jobs in the month of June. The growth has managed to exceed the estimates, that of 2,20,000. That sort of spurred worries about Fed's next steps. The US macro cues, the Labor Department is going to be releasing the June payrolls data today. The official data is likely to cool off to about 2.40. And across the screen that you're seeing right now, both in the pre-market US, the pre-market futures are not really indicating such a gap down, but Asia is bleeding. Across the board, you are seeing 0.5% to about 1.5% kind of cuts coming in. For our markets, we don't seem to be taking it off at all from the global weakness, because even yesterday when Europe kick-started trade, or for that matter how Asia panned out, it wasn't the best of shapes, but our markets continue to be in a momentum of their own, and we've already welcomed 19,500.
Yeah, so Ayesha, you look at the global setup. I mean, there is a bit of a step back for the bulls, and frankly, it's visible because the problem with the US market has been that you've seen this one-sided move in technology stocks, and you've seen a one-sided positioning in terms of where the market, global markets would be and where inflation is headed. All the constructs gradually are getting challenged. Interest rates have not peaked out for US markets. Inflation worry is clearly not behind us. And C, there is a question mark which is now being asked in terms of what the AI-dominated stocks and themes could be do. So the question is, are we likely to shrug off global cues? Can we maintain our own, can we really chart our own course, given that the internals, the momentum, and the big picture argument for India, I guess, is very, very different. We'll talk about it. But if you frankly ask me, now is the real test, because what we've seen in April to June and April to July, I guess, is a function of Indian markets outperforming, but the push also was coming from global markets. If global markets, they retreat, can we continue that chart of outperformance? You will outperform, but will you outperform the fall? Or will you fall and you will fall less? Or you will not fall at all? These are the three questions.
We're just looking at the market positioning as well, and I'm looking across sectors, be it autos, be it banks, be it capital goods, barring, I think, consumption, which is a neutral, or IT, which is an underweight. Across sector, ahead of the Q1 numbers, the positioning seems to be extremely bullish. And that may not be such a good thing right now in this kind of a market.
That's the problem.
Yeah.
I mean, you're looking at data in the morning, and let's look at that positioning. This is the point I just want to bring out. I mean, if you're a trader, if you're an investor, what is that you need to focus on? We'll talk about the Nifty part in a second right now, but let's look at the positioning of the market. And the positioning of the market is following. Auto, extremely overweight. Banks, overweight positioning. Capital goods, overweight positioning. The outlook there is bullish. IT is the only sector where market positioning is underweight. Outlook is bearish. Consumer, I would say, it was neutral, and it is neutral in terms of outlook because it's going to be in divided sector. Now that's the problem for this market. Now, you can argue and say that 19,500 on the Nifty, FI buying it continues. But for markets to keep on going higher, you need a trigger. That trigger either has to come in this continuous dose of liquidity, which could happen. It has to come in terms of a macro change or a trigger, which is unlikely in the month of July, or it really has to come from earnings season. The problem with this earnings season is that everyone is on the same side of the boat. And the risk for this market is that if earnings season is slightly better, if you are in for no big upgrades, you are in for more downgrades, then the market actually would see sell-off. So in the near term, the numbers, earnings season has to be strong. Companies have to not only meet expectations, they have to beat expectations, and the positioning of the market is such that a little bit of miss here and there, sector, let's say in autos, positioning is extremely overweight. Bank, outlook is bullish, positioning is overweight. Capital goods, outlook is bullish, positioning is overweight. With the exception of IT, that's a challenge for the market. Yeah. Now, what do you do in this market? That is very different than what the positioning is. Look, in this market now, if you are long Nifty, you don't sell the Nifty. And you don't short sell, please. You don't short sell at all. Yeah. If you are,
at best, you do nothing.
You do nothing. Yeah. Sometimes in the market, you have to go through the phase of just sit tight. If you're enjoying, make hay while the sun shines, enjoy the positioning. And if you're on the long side, just don't do anything. I think it's time to get not choosy, but time to get very, very choosy in terms of buying mid and small cap stocks, because there is a froth happening there. So if I can use the word lazy and choosy, large cap stocks become lazy, mid cap stocks become choosy. Yeah.
Okay, that's the mantra, lazy and choosy. And just going by the kind of trade setup we witnessed as well, Nikunj, you were talking about liquidity, at least for the past few trading sessions. The FII flows have been intact. That has been on our side. 7 straight days on the trot. DIIs as well have continued buying. The broader markets as well are holding quite well. And as we said yesterday as well, we did have that tryst with the 19,500 mark. But let's also discuss the kind of action as well that we've seen within the primary markets, and understand that, because it has been fairly active as well. We've seen quite a bit of participation coming in. You've also got individual stocks that have been in the spotlight. You had the Senco IPO, IdeaForge as well listing in. The listing coming in, and the kind of subscription that they have witnessed as well has been fairly strong.
No, look, it's not strong, it's crazy. Overall subscription 100 times.
Yeah.
See the subscription numbers in a bull market, and given that the whole IPO window is now less than 7 days, obviously it's going to be very strong. Why? Because you pretty much know that, see, if it's a 20-day window, markets price, the promoters and merchant bankers, they price the IPO based on the current market scenario. But a lot changes between 15 to 20 days. So that's the risk which nobody wanted to take earlier. But right now the window is curtailed to less than 7 days. And SEBI is talking about 3 days now, which automatically means that the market risk to some of the IPOs is not there. The valuation risk and the macro risk is not there. But since you're in a bull market, an IPO market is a market where you know that if you get shares, you can sell higher. And if you don't get shares, there is no downside. There's always a crazy amount of subscription which is there in some of the niche companies. Let's look at IdeaForge. It's a great company. We met the promoter, very smart promoters. They're doing a business which I think is a high growth business. But my problem is that just look at the valuations. While everything on the matrix I think is going to look strong, but look at the valuations. The revenue for FY23 was 186 crore and the PAT was 32 crores. In front of that, you're looking at a market cap which is about 5,000 crore. So for a profit of 32 crore, even if it doubles in next 3 years, we are paying what? A valuation of almost 5,000 crores. My limited point is that there is just no money left on the table now. And but that's the bull market.
Yeah. IdeaForge, 28 times in terms of the 12-month PE is what we're seeing, and in comparison to some of the other players as well, it does stack up as a fairly expensive valuation. But yeah, anchor investors, the likes of Nomura, Goldman, Tata AIG, and the overall subscription, as Nikunj said, has been quite mind-boggling. Okay, let's discuss market levels, and we've got our chartist waiting by to do just that. Nuresh Mirani is with us right now, and Nuresh, a 0.5% gain after flirting with the 19,500 mark. We settled in just a smidge below that level. Given the fact that at least the liquidity is in our favor, the broader markets are looking upbeat, what's your strategy for the day?
So just the way it has been for the last couple of sessions, expect index to consolidate. But even in the last 2 sessions, we saw different heavyweights giving a push. A day back, we saw HDFC Twins actually taking a downtick, but the market still held on. Yesterday, it was Reliance Industries which gave a push, and we went all the way to 19,500. Now, the earlier range for the index was 18,600 to 900 roughly. In that case, the target price for the move is already done. We are in a little bit of an overbought stage, and we are starting to diverge from the global markets as well. We've not seen momentum in the last 3-4 sessions globally, but we've continued to hold on to the momentum in Indian indices. So clearly the flows are pretty strong. But in this case, the risk reward is not great at 19,500 for a fresh long. So time to take no trade on the Nifty, focus more stock specific, and time to get a little more defensive, because a little bit of a pause, even a dip back to 19,200 could take some stocks down which have over moved in the near term. So for now, it's a time to play a little more defensive, be very stock specific, and be alert on your stop losses.
Right. Kunal, yesterday and today more so, the global screen is looking a little bit challenging. For our markets, we've been talking about consolidation, the fact that parameters are looking overbought, but our markets are running on a steam of their own. We're already at 19,500. Can we replicate the same for the next few days as well, wherein even if global markets are weak, we continue to outperform?
So that can happen, Ayesha, but then point is that will that be sustainable, and as well as will the markets probably take more positivity, where you see global markets going down in a linear manner, as well as most of the other indices as well as our sectors, they manage to outperform. Such kind of divergences, they generally don't play in a strong global bull market, what we've seen over the last 3-4 months specifically. Now, there are a lot many factors which have started to get into an overbought territory. We've discussed put call ratio a couple of days back, that how that has shot up for Bank Nifty. You look at the last 3 days of performance, just plainly the Nifty's made a new high at the 19,500 mark. The Bank Nifty's failed to cross over the previous highs of 45,650 for the Bank Nifty on the spot levels. You have fresh sectors which are participating, underperforming stocks, so the more beaten down stocks, they are seeing a leg up. So it's the different texture of the markets altogether. The momentum stocks have somehow taken a stall. HDFC Bank, for example, have taken a bit of a pause. So there are many large cap names which have taken a pause. There are beaten down sectors which are making a comeback. The penny stocks, if I can call it so, or the cheaper stocks in that regards have started to get into strong price action. So we are getting into some sort of a frenzy or an exuberance over here on the charts, and if the global markets get into further correction, I would believe sooner or later our markets will also get into a mild correction. So not expecting a major cool off as I mentioned yesterday, but 19,200 could be a good retest for the index if it happens over the next couple of days.
So what should be the strategy now? Lazy and choosy? Don't do anything if you're owning large cap stocks, and be very choosy when it comes to mid cap stocks now and small cap stocks.
Absolutely, Nikunj. So you have to be very choosy. You have to trail your stop losses. You have to reduce your position sizing. See, what happens is when there is too much of confidence, there is always a propensity to take more risk, to leverage your positions as well as to try and take more margin funding. But in these kind of market, when there is sudden, the factors which were there over the last maybe 1, 2, 3 months, if those they start to reverse, India VIX is not at 10.5. We are almost at 12 plus for India VIX. So when these factors they start to change, these are the first signs that the markets are about to get into a bit of a change of trend. So it's always better to try and change your strategy or tweak your strategy a bit more. Reduce your position sizing, by maybe 50% or 60%, and then try and reduce the leverage. I think that's the most important part, because what would actually happen is if the markets get into a sudden correction mode, you would be left off with too many long positions, and that with a higher set of leverage. So I think that's the only risk which I think a trader has to take note of.
Okay.
Yeah, boring sometimes makes you money.
No, Ayesha, if you actually you read any classic market wizard, and classic market wizards, whether it's Buffett, Warren Graham, good old Rakesh Junwala, Ramdev Agrawal, they all are a big votary of buy and hold.
Yeah.
That is something which really has worked like a charm. You look at where some of the stalwarts have made money. For Rakesh Junwala, Titan has been a 20-year plus holding period. Look at the holding period here. The fact that you do not act and react to just about every monthly update, quarterly update, is the time you can really ride the business and you can be with the promoter in terms of a vision. But that buy and hold is something which, if you are with a good company, works classic. And if you're in a country like India, where you know that from $3.5 trillion you headed to $5 trillion, and from $5 trillion to $10 trillion eventually, the growth highway is so strong that if you are with the right set of promoters for the right group of companies, I think that's a simple no-brainer. Let's look at Kunal. I mean, Kunal's been holding on to Tata Motors for a while now. And what really has worked for him is the fact that, even though Tata Motor must have gone from for 400 back to 280 or 300, Kunal decided not to sell his investments. And that, I'm sure, has worked like a charm for you. The amount of effort you may have put in trading versus the amount of effort you put in buying a good quality franchise, your reward would be disproportionate here. But when it comes to the near-term part, I mean, I'm using the words lazy and choosy on purpose, and it's just something which I've thought through it in the morning. You want to be lazy because there is a phase in the market where you would be rewarded for activity. It happened in the month of April, May and June. You were rewarded for your activity. Yeah. The more you were trading, the more you were leveraging, you were rewarded for that. In April, May, June, you did not have to choose. You simply had to have a courage to participate. But right now, that is not the time, because you're reaching that level where, like Kunal was saying, you will get few trades wrong. And you have to be very selective, because the margin of the safety, whether it's valuations or levels, are not there. So be lazy. If you hold on to something, the market has not turned, so don't sell. But don't be active just for the sake of being active, and be choosy, because not everything will make money. So the mantra for next few days, I would still say lazy and choosy.
Okay. But what about the traders? Can they afford to be lazy or choosy? Choosy, yes, for sure. Naresh, what are your stock-specific ideas?
So trying to be more defensive now given the market conditions. So first is a buy on Bosch Limited, the stock which has broken out yesterday and has been a relative underperformer in the whole auto pack. 19,500 to 20,000 has been a significant resistance for the stock. Yesterday the stock came very close to it. Expecting this to break out and make a fresh move towards 52-week highs. Stop loss at 18,900 and a target price of 21,000. Second is a buy on Hindustan Unilever, a short-term breakout done, 8 to 9 month breakout done, and holding above the 2700, 2740 mark, which was the resistance. So now a stop loss to be placed at 2690, a target price of 3000.
Okay, let's find out how Kunal is being choosy as well in this market. And Kunal, what is it that you're hand-picking or cherry-picking?
So Avanne, two of the stocks, so I'm betting on the strategy that most of the underperforming stocks could make a comeback. So two stocks which have underperformed, betting on them. Tata Chemicals is the first stock. Stock is on the verge of a triangular pattern. It's almost like a 1 year of consolidation for Tata Chemicals. So expecting a breakout pretty soon. Targets of 1080, stop loss at 980 for Tata Chemicals. The second is Avanne Bandhan Bank. That stock has shown a severe correction in the last few weeks, but the stock yesterday managed to fill the gap which it created in 2 days of selling pressure. So that could be a strong enough indication that maybe the worst could be behind, or at least over the short term. Targets of 240 for Bandhan Bank, stop loss at 224.
Okay, there you have it. Those are some of the top trading strategies that our chartists are flagging off. Let's also keep an eye out then on the individual stocks that we'll be tracking then in today's trading session. And it's interesting because Titan as well came out with their overall updates. Revenue growth has been quite steady on a year-on-year basis for Q1, and their individual segments as well, Nikunj, have managed to perform. We'll be, of course, talking about the updates coming in from the likes of Dabur and Soba, but Titan, we were just alluding to the 10-year story, being patient with this stock, and now their latest updates.
No, see, 20% growth on a base of Titan, I think, is extraordinary. We can endlessly argue till cows come home that, okay, stock is expensive. But great stocks do not correct. And when they correct, you should have the courage to buy them. That's the Titan story for you in very simple terms. That it's a great franchise which continue to grow even on a large base. What you got to ask yourself is that why is the growth 20%? For Titan, last couple of quarters really have been slightly puffy-duffy, but a 20% growth coming back for Titan, I think is very impressive. I will not be surprised that based on the quarterly update, there could be an inclination by most of the brokerages now to stay bullish on the stock, because this in a sense would act as an harbinger that the slowdown what the business has gone through, the slowdown now seems to be settling down. So for me, Titan numbers are impressive. The stock deserves to command this kind of an P multiple, and it absolutely amazes me that on this kind of a large base, what kind of growth actually they could do. I mean, on the similar pattern, if I look at Semco, which is a very small IPO, it is in the jewelry business. They are much smaller company in terms of base, but they are not, the historical growth rate is actually not 20%, and margins are nowhere close to Titan. So Titan is like the top of the league stock, and it deserves to command this kind of an P multiple. And my point here is that if a issue of Semco can get that kind of an crazy subscription, which really is not like the best if you compare the numbers with the Titan, so then why should Titan not command a P multiple when they're growing and the margins are the best?
Yeah, they're the Ayesha of the jewelry market.
Aisha's business is getting challenged.
There is no Harley and Maruti giving them competition, but let's see what Senco does today, or rather Senco does when it lists. The subscription numbers, of course, are mind-boggling. The QIB portion has been subscribed 180 times. The NI portion subscription has been about 65 times. And the retail participation also has been at a staggering 15.5 times. That's the kind of oversubscription that you've seen for Senco. Okay, let's move on. Let's talk about some of the other quarterly updates. It was not just Titan, but Dabur as well. Now, given the backdrop of Dabur's quarterly performance, the previous time around, they've actually given a positive commentary. They've said that their business has grown actually 10% plus in the first quarter. And the commentary as well is not looking all that bad. They're actually talking about a recovery coming in pretty soon.
It's a very mixed picture,
Yeah.
Ayesha, what you got from Godrej Consumer versus Marico versus Dabur, they're just not tying up. Look, Dabur has struggled, and Dabur's portfolio is very niche and a very rural-focused company, and you know that they really are trying to reboot themselves, but they've struggled to really come up with something very strong or something which could be called as very innovative, or they've not done any large acquisition per se. So I will not read too much into the Dabur numbers, frankly, per se, but with the only assumption that, look, for companies like, for FMCG sector, I don't think anything materially would change in this earnings season because A, they are expensive stocks. B, markets have lost interest in them. The positioning is not there. And I think it will be at least 1 quarter more, or if 2 quarters more, before we really get a sense that, where the rural dominated franchise is moving, what is happening to margins. Because the quarter gone by was not very inspirational. And the current quarter also does not look all that exciting.
Okay, there you have it. That's the outlook coming in. And yes, indeed, it has been very different when it comes to the kind of commentary that the FMCG majors have been posting when it comes to their Q1 updates. Let's move right on then. And RIL in the spotlight, the NCLT has approved a Reliance Industries financial demerger. This is it just took place yesterday. We've got Deven Choksi as well, who's now joining in on the show. Deven, just give us a sense as to what exactly you make of this, because it was in the month of May that the creditors had approved this spin-off of Reliance Strategic Investment, which is Geo Financial Services, and it looks like now things are finally taking shape.
Yeah, good morning, Evan. Obviously, I think this is a news setting which is already in the market. They already got the approval from creditors, as you rightly mentioned. And yesterday, or even on 20th of June, I think the NCLT approved the scheme, for which I think yesterday the order must have come. That is where the announcement has come. I believe that I think this is going to be definitely a good value addition as far as I think the Reliance Group shareholders are concerned, largely because of few facts. This company is starting with underlying net worth of about 1,50,000 crores. Out of which I think about 1,10,000 crore worth of shares of Reliance Industry that they would have, and balance I think in form of the real net worth that they have, which means that I think they would be starting in a very, very strong proposition compared to their peers in the marketplace. If Bajaj Finance is the largest retail NBFC today, I would say that I think about 44,000 crore is their net worth. Vis-a-vis that, I think the Geo Financial Services would have around close to 1,10,000 crore from share, then balance I think from the cash, so around 1,50,000 crore kind of a net worth they would have. So immediately they would have an advantage of having a higher amount of AUM going forward. Largely two areas where we see the kind of a growth coming in from them, or the strategy getting employed by them. One is merchant lending and second is retail lending. They already have a retail book of around close to 2,75,000, 2,80,000 crores on annualized basis at the end of last quarter, which I believe is growing at around 15% rate of growth. So close to 3 lakh crore worth of retail revenue book that they have got. On one side, the merchant lending, which could be I think easily around 25 to 50,000 crore per month kind of a requirement that they would have. And the balance amount would be, I think, from the retail lending, where the NIMs are significantly higher, given the subvention pricing mechanism that they follow. So Reliance Geo, or the Geo Financial Services, remains, I think, a strong proposition as far as I think the outlook is concerned on NBFC side. And that definitely holds good for shareholders because they are getting 1:1 equity out of this particular proposition. So certainly, I think you are getting a relatively better visibility for your investment going forward from this particular company.
To break it for our viewers here, Devan Bhai, for the current shareholders of Reliance, before the record date, the Geo Financial Service will come for free. You will get shares of Geo Financial in your demat after the record date.
That's right, absolutely. I think you are getting 1:1 share allotted against every share that you are holding for Reliance Industries.
My next question is that Reliance, up until now, has always created businesses and then they've listed them. Whether it has been there are RPL or talks of listing other businesses. In this case, they are giving birth to a business and they're giving you free share right at the birth. It is very unusual practice and unlike what the historical precedence has been.
Yeah, I think, but in financial services industries or the financial NBFC business, probably I think they couldn't have done it the way the other businesses got built up, particularly the manufacturing side of the business or industrial side of the business, even for that matter, consumer side of the business. Because in the NBFC business, I think you definitely require a separate entity to operate for. And as a result of which, I think this particular entity had to take a birth if they want to grow it further. Because I think, as I was explaining, on one side you have got the merchant lending taking place. If they do it from the same company, conflict of interest would arise. If they eat from the same company, I think the conflict of interest will right for even retail also. And certainly they can't even tap the other areas, including I think the stockbroking and the lending related to the shares, etc. They can't tap that particular business either because of the regulatory requirement of RBI on that front. So all in all, put together, they had to give birth to a separate company with a sizable amount of net worth, so that I think the advantage that which otherwise they did not have earlier will now get materialized because of I think the ramping of the books at a much faster pace than otherwise. They probably have the market ready. That is fundamentally very important. On retail side of the business, they have got market ready. Due to money control in their portfolio, they also have, I think, the list of investors already onto that particular portal. So they have market ready for approaching them for generating the business. Of course, it is not going to happen in one quarter, I agree. But at the same time, I think if you are planning for 2 or 3 year journey, you are likely to make a very significantly large size book. I may be exaggerating if at all. I think this number sounds big. I think it could be, I think, beyond 10 lakh crore worth of books that they may end up creating at the end of third year. So I think this is a really large proposition which is happening for investors of Reliance Industries.
Yes, indeed it is, and we'll have to watch out how Geo Financial Services as well disrupts that space. Thanks so much, Deven, for those details. Quick break, be right back with Stocks in News and Stocks on the Editor's Radar.
Back with the market, right here on ET Now, the GIFT Nifty indicating a flat start for us, even though the handover from the globe on account of the employment data in the US is not looking all that great. In fact, across the Asian screen at least, you are seeing deep cuts now emerge. Everything from Australia to Japan to Korea, Hong Kong, Shanghai, all these markets are down anywhere between about 0.5% to as steep as about 1.5% for markets like Korea. But you know what? FII flows remain net positive for the 6th straight session for India at least, or fortnight rather, in the second half of the month of June. In fact, let's try and analyze this data a little bit more. Which are the sectors that saw most inflows and which are the ones which saw outflows, if at all? Samit is here with all that data for us. Samit?
Well, on the FII front, if you see, it is the 6th consecutive inflow that we are seeing on a fortnight basis, and it stands at around $4.15 billion. And the total inflow that we have seen so far in 2023, that is the first half of calendar year 2023, it stands at close to $9.26 billion. Now, the largest inflow was seen in the financial service sector, and during the first half, the financial has received nearly 37% of the total inflow that has come in the equity markets. Now, though the sector has a weightage of around 33.7% when it comes to the FII basket, the ownership has actually declined compared to the average levels that we have seen since January 2020. Now, capital goods is the sector that has seen the second highest inflow in the first half of calendar year 2023, and FII weightage has increased to around 5.4% from 4.4% that we had seen in the start of this calendar year. Auto sector has also been among the FII favorites, and FII ownership in the auto sector is at a 3.5-year high of close to 6.5%. On the outflow side, it's the software and services and media and entertainment that has seen an outflow for the 4th straight fortnight. And lastly, some trend reversal trends that we are seeing. Firstly, in the services sector, which includes port, logistic, aviation, manpower, some outflows were seen, and this marks a reversal in the buying trend that we had observed over the last 4 months, and the highest sell-off we have seen in the fortnight that is in the second half of June in the last 15 months. However, the ownership in the sector stands at around 1.8%, which is still at its 3.5-year average. On the other hand, consumer durable sector, which has seen some weak inflows, in fact, it was continuously seeing outflows for the past 8 months. Now, this has changed over the last 2 months, and we are seeing fresh buying interest in the consumer durable sector. In the month of May, there was buying of around $129 million, and in the month of June, there was buying of close to $497 million for consumer durables.
Okay, that's interesting, breaking it down in terms of the individual sectors that the FIIs are pouring money into and exiting. But But moving right on then, let's keep it with trends from the FMCG space and the Q1 updates as well. You've got Titan and Dabur that came out with their operational numbers. Let's get in all the details as to how they've performed, how Titan has done on individual businesses as well. Vinny's here with that roundup. Vinny?
Absolutely, and let's talk about Dabur first. Now, in terms of when you're highlighting in terms of the demand, urban and rural demand, the company said that they have seen an improvement coming in over there. Consolidated business is expected to grow by 10% in Q1. International business also has seen a strong performance, double-digit growth even in the international business in constant currency terms. The healthcare and the personal care business, that's the HPC business, that has also seen a double-digit growth in terms of value, backed by a mid-single-digit volume growth in terms of volumes. So yes, strong growth that is seen in healthcare as well as the HPC segment. Now obviously the summer centric business where the beverages were included, that has seen a bit of a muted growth because of that unseasonal rain factor that has come into play over there. Badshah Masala, that continues to show strong momentum and has seen a growth in high teens, while gross margins and EBITDA margins are expected to see an improvement given that we're seeing a reduction in terms of the inflation. Now when you look at what brokerages are highlighting, Morgan Stanley is maintaining an overweight rating given a target price of 606 rupees per share. They said that the improving demand trends and top line growth and gross margins is something that is working out well, while the management seems optimistic in terms of the outlook. Now talking about the discretionary side, when we have Titan that reported its a strong growth in revenue of around 20% on a year-on-year basis, so better than what the street was expecting. All consumer businesses are exhibiting strong growth for the company. Segment-wise, jewelry saw 21% growth, watches saw double-digit 13% growth, eye care division saw 10% growth as well. Akshaya Tritiya wedding seasons were something that supported the growth despite the gold price volatility. So yes, overall Titan also saw strong growth, and in terms of that, Citi is maintaining a buy on Titan given a target price of 3,020 rupees per share. Q1 update was better than what the street was expecting. Growth journey is continuing for Titan and positive in terms of near-term outlook for Citi in terms of the growth prospect for Titan.
Okay, that's Titan in trade for you. Look out for that one, as a whole host of others as well. Remember, Q1 updates are still continuing to pour in, and names like Sobha Developers, Shyam Metallics and Tata Steel as well came out with their quarterly updates. Vamakshi is here with a quick roundup on how the commentary was from all these names.
Well, yes, let's start off with Sobha. Now, the company reported a good performance in a seasonally weak quarter. The company has, in fact, managed to achieve the highest ever quarterly sales value of 1,465 crores, and out of which 54% was contributed from Bangalore itself. This has been achieved with the highest average price realization of almost 10,500 per square feet. Other than that, Phoenix Mills also came out with its operational update, and they highlighted that aggregate consumption during the quarter stood at 2,580 crores, an uptick of almost 18% seen on a year-on-year basis. They saw quite a very strong ramp up in the trading occupancy across all malls. As far as the commercial segment is concerned, they have highlighted that there was some strong leasing traction as well. Now, as far as their residential real estate business is concerned, they saw some strong sales momentum out there as well. And in fact, they reported residential pre-sales and collection of almost 135 crore each in Q1. Other than that, Shyam Metallics in focus, we did see sales volume rise for most of its products, but the realizations have dropped for all of the products. Now, sponge iron saw a 12.7% rise as far as volumes are concerned on a sequential basis. Steel billets also saw an uptick of almost 19.7% in sales volume quarter on quarter, but the realizations for both of them have been dropped. Other than that, long steel, including TMT, wire rods, structurals, the volumes for this have declined almost 8.2% on a sequential basis, while the realizations have dropped by nearly 4%. Tata Steel has come out with a mixed set of numbers. India steel production did see an uptick of almost 2%, but it is the European business that actually took a hit. The steel output was down nearly 26% on a year-on-year basis, and in fact, exports also moderated on a year-on-year basis. Other than that, lastly, let's focus on Kalyan Jewellers. A good update coming from this counter. When we look at the consolidated revenue growth, it is nearly 31%. India business revenue growth has come in at 34%. They have highlighted that the strong operating momentum has continued, and that was mainly aided by Akshaya Tritiya. In fact, the Middle East, as far as that market is concerned, strong momentum is being seen in footfall as well as revenues. 21% growth is what they've reported, and in fact, they launched 12 stores, and in fact, they're expecting to launch 20 showrooms across non-South markets before Diwali. So on the back of all these Q1 updates, watch out for these counters.
Kamakshi, those are all the Q1 updates, getting them a lowdown. But moving on then, let's hear out some top fundamental stock ideas. Sandeep Sabharwal, he's bullish on VA Tech Babag.
Some of the earlier stocks which we were holding continue to do well. So I think just holding on to them. Among the stocks which have been consolidating, I think VA Tech Babag still looks good to me because that stock's moved up, it's consolidated, but the performance is quite strong. So I would still think that could have a sizable upside over the next 2-3 years.
Right. Okay, let's welcome on board Digant Haria as well from Green Edge Wealth and talk about what he's making of the market right now. Digant, hi, morning. Can't take my eyes away from the Senco subscription. Was it a subscribe for you, or would it be when it lists? Would it be a buy then?
Hi, good morning. Thank you for having me on the show. See, this whole rich man's consumption basket, we've been just talking about it for, say, the last 1.5 years. And, this is the basket which keeps on doing well. The jewelers, the real estate companies, the fashion retailers, all of them continue to report good numbers. So I think this is a space, which will do well because of the wealth created in the stock markets, in the ESOP, in the ESOP ecosystem, in the tech and fintech ecosystem. So I think the space is good. It's a big buffet out there, and Senco is something we like we like jewelers who are, say, more pan India and who can really appeal to the working class who wants, say, smaller size jewelry, but you can keep on buying more and more in terms of fashion jewelry, not just the wedding jewelry. So I think we'll stick with Titan, and we would evaluate Senco over the next few quarters as to how they change their strategy from being a very, very traditional kind of a jeweler.
180 times. Hello, sir, is what I said when I looked at the numbers. QIP 180 times, retail 15 times, total 73 times. A lot has changed now. The numbers are looking very crazy also because the market risk now in IPOs is getting minimized. There used to be a big market risk because when you would apply or subscribe to an IPO and by the time it lists, it used to be a 21-day process. That's come down to 7 days, it will come down to 3. And that means the market risk which anybody was taking, that market risk is getting reduced. If market risk is getting reduced, the ability to take a risk in terms of the quantum, I guess that increases, and that also explains that why the subscription numbers have been absolutely crazy. I'm going to shift gears, Digant, and talk about a space where we've seen a huge amount of repositioning, and that is autos. The auto space is looking okay, but it is not that the sector is going through a massive bull run per se. Two-wheeler companies are still struggling. There is disruption which could happen in Ayesha's business model. Maruti is trying to get their act right, and Mahindra & Mahindra is commanding the lion's share of SUV market. So this sector is going through a very diverse trend, but the auto stocks of late have gone through a linear move. Why is that?
See, I think Nikunj, you very rightly pointed out that even in the auto space, if we dissect between what the affluent class would buy and what the non-affluent class would buy, the trend is pretty clear that the stocks which are operating more in the non-affluent class, the two-wheeler stocks, they keep struggling. It's only the high-end two-wheelers which the city-based affluent middle class is involved in. That's a segment which still has some kind of growth. And then you have all the cars which are about 10 lakhs, the premium cars which is showing a lot of growth. So I think somewhere down the line the stocks are assuming that there will be a broad-based recovery. I'm not so sure if there will be a broad-based recovery across. So to my mind, auto stocks have clearly run ahead of fundamentals. And see, we have always seen that whether it is two-wheeler or four-wheeler, there are 3 or 4 big players and all of them have reasonable market share. They all have good balance sheets. So they will keep fighting in a market which is not growing too much. And hence, I think, the profitability will always be just about normal. You will never see super normal profitability even in good times for these auto stocks. So I think directly playing auto stocks from these levels, I just feel that the risks are pretty high, and there is a whole ecosystem below the auto stocks which one can bet on. For example, the commercial vehicle financiers, they will probably do quite well, much better than the auto sector, just because they do the used vehicles as well. Then you have a lot of auto ancillaries which are exploiting the export opportunities, the opportunities opened by Europe plus one or China plus one. So they will grow better than what the India's auto sector can grow. So I think these are the pockets where we are trying to, play in the auto sector. So not the direct frontline auto companies, but say, one or two notches lower, the suppliers to them, and, which have more themes than just, the number of vehicles sold in India.
Let's get a move on then and focus in on stocks on the editor's radar. And today we're discussing PSU Banks. And it's interesting, Nikunj, because you've been talking about this sector for the past few days, the risk reward, the margin of safety looking good. And now we're seeing that catch up to the private banking peers.
See, this was like the darling sector of 2022, but 2022 was very different. These stocks were depressed, and they came up because the market went through in complete re-rating towards Sasta, Sundar, Tikau, the value stocks. They made a comeback. Last 12-month return in some of these stocks, Canara Bank and SBI, and even for that matter, BOB is quite impressive. Yeah. They are up 25 to about 100% depending on the stock we're talking about. So they are not laggards per se. But in the recent leg where FI money has come back, they've been laggards. And it's only last couple of days they've rediscovered their momentum. My limited point here is that I think markets historically have always rented these stocks because you've never invested in these stocks. You buy them for a cycle, you don't own them. So it's like saying that I want to date PSU banks, I don't want to marry them. That's how, markets have typically behaved. But I think the things are changing now. A lot of learnings and a lot of new systems are in place for PSU banks. Also, I get a sense that looking at the way how the 10-year paper has moved, how they managed to, the large PSU banks have managed to really protect their liability franchise. They are getting, there's no NPA problem per se. Valuations, there's a stark difference if I compare Kotak with SBI, or even for that matter, if I compare a Can Bank with HDFC Bank, there's a stark difference. So I think there is still some more catch-up which is left in them. If there is one space where markets are not very excited about the earning estimates, I think that's PSU banks. So markets are no longer giving them a stepmotherly treatment.
So time to put the ring on it, you think, for the PSU banks, or still?
Well, the ring is already on, but I guess I think it's going to be a long marriage rather than going through volatility of, an husband and a wife fight.
Okay, there you have it, Ayesha. Those are the stocks on the editor's radar. Looks like it's going to be a long marriage when it comes to PSU banks.
Well, fingers crossed on that one. But Pharma, that's what Dipan Mehta is betting on, and he's picked out Divi's Labs. Here's the reason why he likes that stock.
Companies which are got, say, 25-30% of sales coming in from US, 40-50% revenues, or 60% revenues coming from overseas markets, are that great a bet at this point of time because of continuous price erosion over there. Our preference is for companies which are focused on the domestic market. 3 companies come to mind: Usual Disclosure, Mankind Pharma, JB Chemicals, and Eris Life Sciences. I think they're totally focused on the domestic market. And these are the kind of new FMCGs. They focus on brands. They focus on creating a kind of a loyal customer base for their molecules. And that's what I think drives growth. And from time to time, they do make new product launches as well. So very positive on these 3 companies. And then there are the contract manufacturers also. I'm not completely so negative on Divi's Lab at this point of time. I think the worst may be behind them. Give them a couple of quarters or so, and we should start seeing a decent upswing in their performance as well.
All Digantarya, you may want to just pay attention. In 5 minutes, we will tell you that what Indians are ordering. That list of Zomato was uploaded yesterday, which, by the way, in Bombay, its chart, it's not Vada Pav. Huh? I'm giving you a
That's because North Indians have taken over Mumbai.
Bombay's become a Cosmo actually now.
Totally,
it's no longer dominant. Yeah, I'm from Delhi. You've lived in Delhi.
Kunal, you originally Gujarat.
No, Mumbai.
But they've changed. The palette is changed. It's no longer Vada Pav. It is Golgappa and chaat. That's what Zomato is
Pani
claiming.
puri.
Pani puri.
Pani puri.
Even Samir, remember Chaat Pe Charcha? We did not order Vada Pav.
But he's a Delhi guy. I mean, he's
Dinshu
a
Anani
pani
was also there, yeah. But I'm just generally saying that Zomato data will just come up in next 4-5 minutes. But meanwhile, from Zomato to Jamna Auto. Why? Because Jamna Auto, massive delivery yesterday. Stock was up 5%. You track Jamna Auto, right, Kunal? That's what I remember. Or Nuresh tracks it.
I don't track it.
Nuresh?
Part of my recommendation today, so.
Yes, yes. I remember it getting mentioned somewhere. What do you like about Jamna Auto?
So what has happened with a lot of these auto ancillaries, they've done well. Jamna was not doing well. There was a big block a couple of weeks back wherein Small Cap World Inc. sold a block. And yesterday also there was large volume. Seems like the final selling is over. And the stock has gone nowhere compared to the rest of the auto ancillary space. So the stock is available at 100, 110 where it was in 2018. And over the last 6 to 18 months, the stock has been pretty sideways. 95 has been the bottom. 110, 115 has been the upper end of the range for at least the last 6 months, and 95 was the bottom back in 2022 as well. So the volumes, and this has been the case with Jamna Auto over the years. We saw a similar rally in 2016 after a PE fund sold. So out here, a big block and a huge delivery volumes generally is a start of a new trend. So expecting this to trend higher over the next few weeks. Seems like a lot of selling is over and could surprise on the upside, could go back to 130 levels.
Okay. Digant, which is one, what's been your big allocation in last 15-20 days? I mean, which is one stock where you're still happy to allocate disproportionate amount of capital?
So I think it's just, it's been a sector which I've tracked for many, many years. The NBFCs. You were mentioning in your PSU Bank presentation just a few minutes ago that, they were the darlings of 2022. In fact, PSU private banks both. I think 2023 is turning out to be a year of NBFCs because, the banks will see some bit of margins cooling off, but that's good news for NBFCs. So I think NBFCs is a space where, we're still very, very comfortable with, especially the commercial vehicle finance NBFCs, stocks like, Shriram, Mahindra, Chola. The Chola holding is not the main NBFC because that derives value from the parent. So yeah, I think this is one space where we still see there is reasonable amount of steam left in terms of fundamentals and in terms of the valuation upside also, which is quite possible in these stocks. So yeah, NBFC is one space. Industrials is another space which we think is and industrials in some ways also driving your PSU banks and the large private banks. The capex and the working capital requirements of that sector. So these are two sectors which we think are still okay. If you select the right pockets, even at these levels, 6-12 months down the line, you may not be disappointed.
Right. The other one which is going to be in focus today is going to be Idea Forge. That's going to be listing. The issue price is at about 672 rupees and the grey market premium is already indicating a 75% upside and a premium once this one lists. The total subscription, remember, for this one as well was pretty handsome. About 106 times is what it clocked on its IPO. This is, by the way, a drone manufacturing company and, we had them in the studios just last week. They are the market leader in the Indian unmanned aircraft system or the UAS market, popularly known as drones. Digant, I don't know how much of a case study Idea Forge has been at your end and whether the IPO was a subscribe or now looking at the listing, would you be interested in this business model? Pretty niche.
So from what I saw on the interview and what I read through the DRHP, it just seemed like they have a very good product. When we all talk about India becoming the next big hub for electronics manufacturing, but there is a big learning curve in any electronic products that we manufacture. So I think Idea Force, they really have a good product at hand. Still, and they have got orders from defense and a lot of things under development which the defense would like to take. So I would like to believe that the product is good, and there is a lot of sales which it does to the Indian defense, mainly the Air Force and Navy. So I would just say that, these are sectors which can grow 10, 20 times in the next 10 years. And if somebody has a lead in terms of a good product, that is the company to bet. Unfortunately, Ayesha, in the market like India, you don't get good valuations. The stock came in at say 10 times price to sales. It may list at 15, 20 times price to sales, and who knows, in a few days it goes to 30 times price to sales. The question is, how do we allocate money at such valuations? But yeah, for somebody who does this concept investing or futuristic investing, I think this is one space which can become really big, and this is a good product in that space. So yeah, it makes sense for somebody who's playing that kind of a strategy. For us, it's really tough, though we like it.
Okay, let's get back to the food discussion. It's Friday. Most of us have their cheat days today. So let's.
I'm cheating every week these days, every day.
I said most of us.
Most of us. But what about you?
No, Sunday.
Sunday. Oh.
Okay, so let's find out what's been cooking in Zomato's kitchen. And, Zomato ZFT has unveiled its data analysis platform as well. And this platform apparently is going to provide data for restaurants and will reveal demand as well as pricing and consumption trends of, cuisines across the country. So let me take it across to Vinny and find out what ZFT is all about. And Vinny, what are the initial trends? What are people eating? What are the restaurants which are seeing the longest queues?
Absolutely. This is an interesting platform that Zomato has come out with. That's the Zomato Food Trends. And obviously, when you look at it, this will help restaurants in understanding, what is doing well in the business, what cuisines are doing well, which destinations or which areas is what cuisine doing well. And that is something that will be insightful for the industry in terms of the growth. And they also provide month-on-month demand trends and pricing across the cuisines and geographies as well. So most popular cuisines that are going to be in the state or that city, and the level of analysis will be deeper in terms of that will be provided to the restaurants on this Zomato Food Trends, and this is, as of now, it's free of cost as well. Now, some of the interesting analysis that you already see coming in is that, when you look at a South Indian dish, that is value for money, right? So in terms of with more than 50% of the price point coming in at less than 100 rupees in South Indian dishes, that is the most value for money in terms of what consumers look at. Bangalore as a city alone has more than 80% of Karnataka's state in terms of the orders that come out placed in Bangalore in the state of Karnataka. Most of the orders are placed over there. Other than that, when you look at it in terms of the top 8 cities, Pune has actually nearly the highest per capita restaurant supply across most of the cuisines within these top 8 cities. And also interestingly, when you think like Delhi, NCR, everyone's only eating chole bhature, but do not forget the trend that Jeffries has highlighted in this data analysis that I've seen is that they order as much as dosa as much as they order in terms of chole bhature as well. And Mumbai orders are 1.6 times for desserts versus the national average as well. So a lot of interesting data points that have come in from this analysis, and surely we will be keeping an eye out on how these trends actually shape up.
Okay. All right. Very, very interesting. Very, very interesting.
Mumbai orders 1.6 times desserts versus the national average.
How much are you ordering on a Sunday, Ayesha?
Not even on a Friday. Kunal orders every day.
No, not at all. He does not order, he cooks at home. So.
Oh, sorry, you order for him. I forgot. Yeah.
That is still pending.
No, but just such fascinating data when you look through it. But what amazes me is that if you look at the average price of orders, the average price of orders are still below $250. $250, you convert that into dollar. It's not even
rupees.
250 rupees. Sorry, I beg your pardon. $250. What am I saying? 250 rupees. 250 rupees. You divide that by dollars. That's not even $5. I mean, so average order size right now is less than $5.
Sorry, go
no.
ahead.
So in that, right now there's a huge advantage which is coming to the food delivery companies because of, sometimes there is a service charge, sometimes there is no delivery charge. If the entire quotient of the delivery stroke service charge comes back, could there be a mass reduction in the number of orders which you're ordering? Because if the total ticket order value is less than $4 or $5, imagine if somebody has to pay another 30-40 rupees purely as a delivery charge or the service charge, then will the quantum go down? That's one way of looking at it. Another way, just $5, that's it. Come on, it has to go to $10-15. And if that goes to $10 to $15, imagine the commissions, what some of the food delivery companies will actually enjoy, because the commissions are not the commission are function of price. It is not a function of the number of deliveries you do.
Yeah.
So Digantharya, just $5, if it goes to $10, what happens? And if it, will it change the dynamics for some of the food delivery companies?
I think, so much talk of food that I'll have to have a second breakfast after your show. So, coming to this Zomato.
Ordering on Zomato, ordering chaat.
Oh, no, I don't think they'll get it so fast. I'm hungry enough, while listening to so much of, the food data which you showed. So I'll probably just walk down and get something. So see, as far as Zomato is concerned, you rightly pointed out one fact that the delivery charge and the delivery boy economics is something which Zomato has clearly won. And we see that Zomato is gaining market share all the time from Swiggy in the last 1.5 years. So that is where I think the rally from $55 to $75 in Zomato has happened. See, India, Nikunj, is a country where you just take the aviation sector. They did not raise ticket prices for 20 years. Just because the Indians, they wanted more and more Indians to not use the trains and then use the flights. I think it's only in the last 1 year that Indigo has, got the courage to increase the pricing. I think food delivery is still in a stage where for many, many years, the pricing has to be that 250, 300, 350 rupees per order, because more and more Indians are getting recruited into this food delivery ecosystem. And I think profitability, unit economics is all a story probably after 2027-28. And you're absolutely right that, Zomato can see a very big splurge in its profitability. But see, that's all very, very gradual. In India, you should not focus on profitability too much at this stage, and which comes at the cost of growth, because India, there's a very large funnel that you have to create, that more and more customers get used to this Zomato and the food ordering. But yeah, I think as of now, in terms of economics, Zomato clearly dominates the delivery part, because there are not so many delivery boys available at the rates at which Zomato can hire them. So yeah, Zomato clearly has a lead, but yeah, I think they should prefer growth. We should not go to $10 of ordering size, because our per capita incomes are not growing so fast enough.
Oh yeah, absolutely. I mean, the trivia says that South Indian dishes are clearly value for money, and South Indian dishes, the price point for 50% of the orders is actually less than 100 rupees, and the average gap between burgers and pizzas is less than 20%. It's actually momos which were ordered 2x of vada paos throughout India. 7% of the biryani dishes, the average selling price is again less than 100 rupees. And for burgers, it's a little higher than about 400 rupees or so. There's lots more interesting data, but before Digant actually, logs out and runs across for his second breakfast, I'm going to switch gears and talk about something else. Small cap funds. Now, very interesting news flow coming in here. There are two schemes which have actually stopped taking money in their small cap funds. That's Nippon AMC and Tata AMC as well. Now, Nikunj, there could be only two possible reasons for that, right? I mean, either the mutual funds think that the valuations are expensive now, or then they don't see any opportunity now within small caps. Newer names, that is.
Both, I think, is applicable. Yeah. And they both... See, ultimately, if you look at the business interest of any AMC, they need large scale and size. Why would you say no to new business? The only reason why you want to say no to new business or new flows in this case would be then when you are not sure that the past performance is going to be repeated in the near future. When do you take that kind of a call? When valuations have run up, or when you think there are going to be event uncertainty and there are going to be challenges in terms of the macro environment? Nobody can predict macro, but I think it's a call which most of the mutual fund schemes and the sensible ones have taken, and past data where some other AMCs have done that, I think they've been duly rewarded for not accepting fresh inflows from clients and from unit holders when the market valuations are looking slightly sticky. And I think that is the trouble with some of the small and mid-cap stocks, where the valuations are looking slightly sticky, and one is better off perhaps taking a backseat if you're really buying into small and mid-cap stocks. See, remember, the small and mid-cap stocks as a category, they have a proposition of higher return, but there is a threat of higher volatility. Proposition of higher return and potential of higher volatility. I guess the proposition of higher return for a long-term investor, 3-5 years is still there, but the threat of a volatility is something which should be there at this kind of a level. So I think fantastic what Nippon AMC and Tata AMC are doing. This is just the right thing, because what you don't want to see is that you don't want to see money getting into the schemes. And remember, Ayesha, schemes do not have the liberty of sitting on cash. They can't sit on cash. That's not the mandate there. They have to deploy. So money comes in, they'll have to deploy it. And if more money comes in, they'll have to deploy more. You have to deploy more at these levels. The future return is a function of what price you buy. So I think this is great news. And historically, some of the smart guys have done it. We've seen that some of the good PMS schemes have stopped accepting money at higher levels. We've seen big schemes in the past, they've done that. We've seen some of the private investors. They said, look, we are not going to be accepting public money because we don't find it very attractive. So this is great news, and I respect when AMCs do these things, that they are not sacrificing, they are not sacrificing unit holder returns just to keep their AMCs and just to keep their books up.
Okay, yes, indeed, that's what the data is pointing towards. Perhaps now valuations are on the higher side, so some of these small cap funds getting overvalued. Just a quick check-in as to what the pre-open rates as well are indicating this Friday morning. Yesterday, after scaling that 19,500 mark, no surprises to see that red tick on the pre-open rates right now, given the fact that you did have quite a bit of choppiness across the global markets, and that's the kind of handover as well that we were given. You also had the S&P 500 posting its biggest daily percentage drop since May 23rd, with the Dow logging its biggest single-day fall since the 2nd of May. So that's why you're seeing a bit of a shaky start. But let's find out those mid-cap strategies then. What is it that our chartists are betting on within the broader markets? And Naresh, what's on your radar today?
So that would be a buy on Jamna Auto. The stock has seen huge volumes over the last 2-3 weeks. There was a big block a couple of weeks back. Yesterday also was a large volume. Technically, the stock has been making same bottoms around 95 back in 2022, as well as in 2023, 3 to 6 bottoms around this area. Then we go a little shorter term. In the last, say, 4 to 6 months, the stock has found a lot of resistance around 110 levels, which was also the high in April, May. And yesterday, the stock tried to break out above those levels. So a price volume breakout done here, expecting it to again recover back to 130 odd levels. Stop loss to be kept at 103.
Okay, let's find out what Kunal's top recommendation is within the broader universe.
That'll be a buy on Union Bank. PSU Banks have done reasonably well. Union Bank is also on the verge of a breakout above the 80 mark, which could be a strong psychological breakout. So targets of 85 for Union Bank, stop us at 75.
Okay, let's move on. And, after the newly launched Threads platform recorded millions of downloads on its first day itself yesterday, Twitter, by the way, has now threatened to sue Meta platforms. Elon Musk's attorney has alleged that Zuckerberg's Thread has been built by former Twitter employees as a copycat app. Meta responded to the allegation saying no one on the Threads engineering team is a former Twitter employee. Also, U.S. Treasury Secretary Janet Yellen has kicked off her 4-day tour in China as a mission to deepen ties between the two countries. Now, this comes after Secretary of State Antony Blinken's visit to Beijing in the last month, which was the first high-level meeting between the two countries after months of tensions coming in. In fact, US and China are trying to find a strategic space for both sides to operate within. Also, Singapore Supreme Court has directed engine maker Pratt & Whitney to dispatch 5 engines per month between August and December to cash-strapped Go Airlines. This gives a ray of hope for struggling Wadia group of carriers taking its wings again. Sources say that Go First may get the DGCA nod to resume flight operations very soon.
Meantime, quick weather check. Even though the monsoon has started late, there has been a massive recovery. The deficit has come down to 5% from the 30% earlier in just 12 days. IMD has issued heavy rains alert for the next few days in many states like Maharashtra, Kerala, as well as Odisha and West Bengal. And shifting gears then to the world of sport, and legendary former India captain MS Dhoni turns 42, and fans across the country are celebrating his birthday in style. Images have popped up on the eve of the special day showing giant cutouts of Dhoni in Hyderabad as well as in Andhra Pradesh. The cutout in Hyderabad is apparently, guys, 52 feet tall, while the one in Andhra Pradesh is said to be 77 feet tall. So clearly, it's very joyous birthday wishes for MS Dhoni.